One size may not fit all for financial advice, an independent wealth manager explains. Plus, an event 8,000 miles away in China can impact the U.S. economy. We'll talk to an economist who will explain why emerging markets are closer than you might think. This is 7-Day View.
Hi, I'm Lydia Morish.
And I'm Mitch Rochelle, and here's what's trending. 2017 will be a year of equilibrium for medical costs. The forces that increase healthcare costs are being tempered by demand for value in the new health economy. PwC's Health Research Institute projects a 6.5% growth in healthcare costs for 2017. That's the same growth rate we saw in 2016. Looking for a silver lining here? When you compare this to the double-digit inflation we saw in the last decade, flat growth may be a win.
Well, it seems the American dream is alive and well. A recent study conducted by UBS and PwC shows that the U.S. is home to the world's largest collection of billionaires. For the first time in 10 years, the average wealth in the U.S. of self-made billionaires surpassed the average wealth of those with inherited fortunes. But although the U.S. accounts for nearly half of the world's billionaires, total U.S. billionaire wealth fell by 6% in 2015 to $2.4 trillion. That's down from $2.6 trillion. Reasons for this drop in wealth include commodity price deflation as well as a reduction in family wealth transfer.
Frequent topics on 7-Day Yield include millennials and financial literacy. In keeping with those themes, a recent study conducted in conjunction with PwC exposed the fact that nearly 50% of millennials do not believe they could come up with $2,000 if an unexpected need arose in the next month. High student loan debt and low wage levels are cited amongst the reasons why millennials are not saving.
On 7-Day Yield, we focused on wealth management from the large institutional perspective. To provide an alternative point of view, Mitch sat down with the CEO and founder of a regional independent wealth manager. Take a listen.
So John, with all of the news stories about volatility in the markets, what are you hearing from your clients right now in terms of what their priorities are?
Well, when it comes to wealth management, they all want to make sure they got the blocking and tackling done right, meaning they want to pay as little in taxes, have a good portfolio, make sure they have the right insurances at the right price, they have good beneficiaries, estate plans, etc. You know what I really find they want, though, is they want someone to kind of oversee everything, to make sure as things change, as situations evolve, there's market changes, there's tax changes, there's family changes, there's health changes, that nothing gets out of kilter and that kind of house stays in order forever.
How do you compare what you do and how you work for clients with the Robo Advisors that are out there, and then the big financial institutions who are also in the business of providing wealth management services?
I'm a little bit in the minority in that I think the Robo Advisor has a really good place in our future. I wish they changed the name, though. It's really Robo Investor. It's not Robo Advisor, because using statistics and technology, you can build a pretty efficient portfolio that's low cost, tax efficient. So I think those tools are going to be really good. The distinction, though, a wealth manager is someone that can talk to people and adapt the other moving parts of a financial plan beyond investments to the entire situation. The large firms are in a pretty good place as it relates to the future of the wealth management business because they've got clients, they've got brand. Many of them have tended to be, product sellers, and they make their own products and commission-driven business, but that's changing, and I think regulation is going to help change that, where I think most advisors, large firm, bank, independent, are all going to have to act like a fiduciary and act in the best interests of the client.
Is an independent financial advisor like your firm as impacted by regulatory changes as a bigger institution is?
Yeah, they really are. In fact, in many ways, the small firm is more adversely affected because they don't really have, in many cases, the big compliance staff and the resources to deal with the regulatory changes. So I think there's going to be a squeeze on the smaller advisors. You'll see a lot of roll-ups. You'll see some acquisitions. You'll see smaller shops, like the Fred's Financial Group, roll into a bigger kind of organization to get scale that's necessary under a highly regulated environment.
One of the things we've talked a lot about on 7-Day Yield is the multiple generations and how they view wealth management services and their needs for them. So let's take millennials graduating from college and sort of compare that to let's date ourselves, our generation, baby boomers, who are moving closer to retirement. How in a firm like yours do you manage multiple generations of clients?
That's an awesome question. In our firm, at least, how I find the millennials is through the parents, because most millennials want to know, are my parents okay? Are they financially okay? Do they have an estate plan? Do I have a role in their documents or in their estate when they pass away? And that's typically how we meet with millennials, and I'm really impressed with what I'm seeing. And they need help too.
John, before I let you go, pull out your crystal ball. Tell me what the next 10 years look like in the wealth management industry.
Well, hopefully the next 10 years will include regulation, and it will definitively define what is a wealth manager. How does that differ from, let's say, a broker or a seller of products? I think it's very confusing for consumers. They think they're getting advice, they may be getting sold something. So I think that's one change I'd like to see. The second is, thanks to venues like this and other publications, there's a lot of knowledge out there and a lot of information. So I think consumer education is going to drive more quality service. And then last is the compensation model is going to change. It's going to look more like a CPA firm, where it's going to be fee for service, and as opposed to multiple sources of compensation.
We have John Stadler, our U.S. financial services leader, in Studio C. Thanks for joining us, John.
Mitch, thanks for having me.
So when you look at the interview that I did with John Napolitano, he's an independent, smaller independent financial advisor. With all of the regulations that are out there and the infrastructure you need to be compliant, how is it the demise of the small independent financial advisor in this day and age?
You know, Mitch, it's a big debate that continues to exist out there. So you've got headwinds in a low interest rate environment with the new DOL fiduciary rules, with the onslaught of continued evolution of regulation that adds a lot of costs, which small managers have a hard time absorbing and still earning a fair margin. What we see a lot of investors looking at is beta, large active equity, product which isn't really kind of driving the small manager, but rather the larger managers. However, investors are still trying to figure out where's that niche outperform. And I think what we're going to see is the smaller managers leveraging outsources in different ways. Technology has allowed managers to leverage the third parties to help them do what they maybe can do, which is drive some beta in different areas and be kind of a pocket among what we continue to see, the growth in passive funds and the growth in kind of some of the larger products.
It was interesting that John actually embraced Robo Advisors, saying that they act more as a robo investing. What's your take on this disruptor in the space?
Lydia, it's a great question, because one of the challenges is if you're going to succeed as a small manager, you need to outsource those type of costs. So use third-party providers, maybe to take some of your regulatory, some of your infrastructure away, but then distribution is a big challenge, and trying to get on organizations' list is such a challenge that Robo Advisors will allow individuals to get access to many through kind of this model portfolio. So there may be a distribution play that's there, but even with Robo Advisors, there's going to be a challenge of too many options, and that narrowing is going to be an uphill climb for smaller managers.
Mm-hmm.
Great, John. Don't go anywhere. We're going to hold you for the whole episode. Industrial production in China surprised analysts recently with data coming in higher than expected. To make sense of the interconnectivity of our economies, Gary Meltzer sat down with PwC senior economist Chris Benko. Take a listen.
Chris, thanks for joining us today. So maybe a quick kind of trip around the world, if we could, and we'll start in the East. There's been so much lately that we're hearing about China and Japan and kind of the impact, not only the local markets, but how that's impacting what's going on here in the U.S. So maybe give us a little bit of your view on what's happening in the East with China and Japan.
Sure. Well, Gary, they're in two different places, right? I mean, you've got Japan is a mature economy. It's an aging demographic, and that's a significant problem for them. The other struggle they have, quite honestly, is despite having very low growth, their currency is extremely strong. And that's making their export base extremely uncompetitive around the world. And that's a problem there. And so there have been tremendous aggressive monetary policy out of the Bank of Japan around negative interest rates. We probably don't see them getting above 1% growth over the next few years. So they're in this situation they're in. China's in a different place, though. China is, it's an emerging economy. It's still growing. It's struggling with a transition of economic reform. So they've been very asset intensive, manufacturing oriented, and export oriented. They want to pivot their economy to be much more integrated into the global economy with different sorts of capital controls, changed how the yuan is viewed in global markets, but also become much more consumer oriented and service oriented, much like the U.S. economy. So what you're going to necessarily have a slower rate of growth with that, but it is definitely a balancing act.
So maybe moving west a little bit, we're kind of 6 weeks post the Brexit vote. A lot of discussion and dialogue. We're going to be doing more on that in one of our other episodes, but maybe quickly kind of, what are we seeing now that we're kind of 6 weeks post the vote?
Well, you're now 6 weeks into the new uncertainty, right? So we've got the new normals and we've got the new uncertainties. And to the UK's credit, they moved very quickly to put people in place and departments in place to begin to address this. But we are half a step down the path of where we need to get to. So you're just entering a 2-year or more negotiating period. So far, there's just very early data coming out on economic results. So it's too tough to tell there. Lots of contingency planning and lots of really strategic modeling, not just quantitative modeling, because the different outcomes are so varied. And I think the bigger issue, if you step back from Brexit, is what this really calls into question is the nature of globalization. Globalization isn't changing, but the nature of it is. We will still be a more globally integrated economy, but more south-south and more east-south than what we've seen. And that's a real game changer for a lot of multinationals.
So quickly, let's continue moving west. So the time of year we're in right now with the Olympics. What do we expect the impact to be on the Brazilian economy, and what have we seen in the past as emerging markets have kind of hosted the Olympics and come through that?
So I think what countries have seen and what cities have seen is the impact doesn't really last. It's hard to sustain that sort of thing. But Brazil has really worked through some of the difficult periods. I mean, you had high inflation, you had interest rates that were going a different direction than the rest of the world, which was having an impact on the currency. And we think that we've seen Brazil bottom and coming back. The timing of this may be just enough to get them on a little bit higher trajectory for growth than they would have been otherwise.
John's still with us. John, when you listen to the interview that Gary did with Chris, I think about multi-jurisdictional institutions and how do they manage multiple cultures, tax regimes, regulatory regimes. In this day and age, I got to imagine that the number of headwinds they have being multi-jurisdictional has got to be a big challenge.
Sure, Mitch. I mean, first off, it's exciting to, as a Villanovan, follow another Villanovan and Chris Benko. So, look, as I look
at
the
national championship.
Exactly. There you go. So, as I look at firms, firms are really trying to think about where do they want to be and how do they want to be effective. I know we'll talk a little bit later about Brexit, but Brexit is one of those macroeconomic challenges, but it's not the only one. It's foreign exchange volatility. It's some of the cost of doing business in different geographies, and that's what firms are really trying to look at right now.
Well, speaking of Brexit, we had Byron Carlock on our show recently, and he talked about the impact of Brexit on real estate. Could you talk to us a little bit more about maybe the direct impact we're seeing in the U.S. versus in Europe?
Sure, Lydia. And some people are getting a little bit of Brexit fatigue. It's a lot of change that's happening at once. The feelings coming out of the UK right now is it'll be a hard exit, which means organizations are going to have to do a full jurisdictional analysis. What's the impact of the Treasury operation? How do they look at people? Because that's a big change on where people can work across geographies. And then also M&A. You know, maybe you need to build it, or maybe you need to go buy a firm you wouldn't have otherwise bought, but because that gives you access into the other markets.
Well, speaking of people, could you talk to us a little bit about the themes that we're hearing from CEOs in financial services?
Regulation is certainly one of the big things that they're looking at, and kind of that regulatory burden. Volatility is another one that they're looking at, but M&A is a theme that I continue to hear. Some of it's the large wanting to get larger, some of it's people trying to get access to different markets. Those are things that the people clearly look at. Millennials are another. We even hear our own Bob Moritz talking a lot in our recent global annual review about how do you work with millennials as a workforce. The last and probably the biggest, and I know you talked about disruption earlier, is technology. And everybody wants to use the word fintech, but technology is going to continue to allow people to adapt to some of these changes. We term it fit for growth. So I can manage some of the burden of maybe regulation, of having to work in different geographies, and still earn what is a fair margin for me, and also deliver what is an appropriate product suitable for my clients.
Awesome. Thanks, John. What a treat having you in the studio. We're going to get you back.
Look forward to being here again. Thank you very much, Mitch and Lydia.
Yeah. We're going to get you back. On our next episode, we're going to get a sneak peek into a new study looking at the world's billionaires. You don't want to miss that. So make sure you set your VCRs to, wait, no?
VHS?
Yeah, all right, whatever. It was on a teleprompter, Lydia.
Pretty sure people don't have VHS tapes anymore, Mitch. Thank you so much for watching. Don't forget to check out our PwC YouTube page and follow us on the Twitter handle below. We'll see you next time on 7 Day Yield.